Well, happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the Last Week in Mortgage Today, where we take you through the week that was in the mortgage industry. And every week, pleased to be joined by one of our lender members as my co-host. This week, back in the co-host seat for at least the third time, fellow Clevelander, longtime friend, the Executive Vice President and COO of Nations Lending Corp, and fellow Clevelander, Eric Roman. Eric, great to see you.
Hey, thanks, Rich. Really appreciate you having me.
Always appreciate you answering the bell, and as usual, no shortage of topics to talk about from the past weeks. Let's go ahead and get into it. As always, our attendees, please feel free, any questions, comments you have, to drop them in the chat or the Q&A, and we will go ahead and incorporate it into the show. So Eric, let's start with the report that just came out from Redfin, essentially saying essentially 15% of all June existing home sales didn't make it to the finish line, kind of fell apart somewhere along the line. Historically, that's not an abnormal number, but it's abnormal from what we've seen this last year and a half, where people are, we'll waive inspection, we'll waive this, we'll do anything. Let's just make a deal. There's no homes out there. To me, it was a sign, maybe a continuing sign of the housing and purchase market starting to normalize a little bit. You're in the trenches much more than me these days. What are you seeing out there?
Yeah, so 15% is probably the highest we've seen since the start of the pandemic. And, when you look at what's happening with these rising rates, you see buyers that potentially are under contract and they're no longer qualified. The flip side of that is you probably have some buyer's remorse in there with a looming recession, and you've got some people that are exiting contracts. If you look at the year over year, builder cancellation rates are 6.6 to 9.3 May to May, right? So it's just a sign of the times.
Yeah, you go back to last spring and it was like the Wild West, right? It's 200,000 over asking, 30 offers the first day. We'll waive this, we'll waive that. And, rates were still very low as well. But now, if you're buying a house and, maybe you locked in 45 days ago at whatever rates were 45 days ago, lower than high fives. To your point, maybe they don't qualify. Maybe they qualified at time of app and something went sideways. They got to relock and now they don't at the higher rate, or maybe they just get cold feet, the buyer, a little bit, because obviously interest rate, big part of the cost of financing a home.
Yeah, you see the buyers that are still in there. They have a lot more negotiating power. I think you're seeing homes stay on the market longer. It's like you mentioned earlier, the inspections are no longer getting waived.
Yeah, more normal. I mean, what was going on was abnormal. So a return to normalcy, not a bad thing, especially for an industry. A lot of abnormal the last 2.5 years.
Heard of what we've seen in the last 18 months, right?
It's really been crazy, and it has. It's a cyclical industry to begin with, but we've seen both ends of the spectrum for sure these last 18 months. And we were kind of talking about it before we went live. I mean, both been in this industry a long time. You think you kind of seen it all. Nobody expected what we've seen so far this year on the interest rate side. We were lamenting before going live, the economists in the winter predicting a slow rise to 4% 30-year fixed. Went right past that. And so we had rates, whatever, ran up all year, pretty much the whole year. And we were in the sixes, solid in the sixes, 30-year fixed rates. Then they really started to fall. We got a couple inflation numbers, some positive economic data, tended to lead some to believe that maybe inflation maybe could be subsiding. But then we had the Fed meeting last month. We had a bad inflation number and it just shot everything right back up. And 10-year Treasury yield's been kind of hovering around 3%, but it's been a volatile year for rates, but these last few weeks have even seen some volatility as we go into tomorrow morning, a huge inflation number.
Yeah, so speaking of statistics there, the labor market in June was really strong. I think we added about 370,000 jobs. The expectation for CPI this week is going to be increased. Unemployment's at a 70-year low, 3.6%. I think the last update the Fed signaled was probably a 75 basis point rate hike. So you've got these things weighing in conflict, and they're trying to really have a soft landing without going into a full recession.
It's a fine line the Fed's trying to walk, right? They're trying to they overshot, I think, after the pandemic and pumped a little bit too much money into the economy. We're seeing the results of that now with inflation. Now they're trying to like shock it back with these bigger than anybody anticipated rate hikes. But to your point, it's a fine line to walk, right? They're trying to slow down the economy without putting it in the recession. That's tricky.
Gas prices, I think, are starting to creep down just a little bit. We might see an easing next month's numbers, but time will tell.
Time will tell. And as noted, yeah, tomorrow morning, 8:30 p.m. Eastern, we get the consumer price index, the most watched inflation number, essentially gauges the cost of a market basket of things that Americans utilize regularly. Last month was up 8.6% year over year. Expectations in tomorrow morning's number, depending on who you look, plus 8.7, plus 8.8. So a little higher than last month. If you see an 8.9 or a 9% year over year number, get your rate locks in.
The largest jump since 1981 we saw last month.
It's crazy. All the craziness that we've just seen in this industry since the early 80s, to say the largest or greatest of anything since 1981 is significant. So, Eric, FHA mortgage insurance premiums, New York Times put out a piece that you could tell had some administration leakage in it, essentially saying Biden administration's thinking hard about reducing FHA mortgage insurance premiums as a way to help bridge to some degree the affordability and racial home ownership gaps in America. We've heard the stories in the past about how the FHA reserve fund is at 4 times where it needs to be. Your thought on FHA premiums as we get into the summer here?
Yeah, so that balance sheet is over 100 billion, 4 times the requirement. There's 2 sides to this argument. The first is it's long overdue for a cut. It can help some people get into it. But the argument on the other side is that it's going to spur demand and increase home prices, pushing those FHA buyers out of the market. So you got 2 angles here. I agree that we're long overdue for a MIP cut on the FHA side, but you get into this political arena, and you got to navigate that, and we'll see how it shakes out.
It's tough. It's like the government is so in mortgage lending. Obviously FHFA is overseeing, and the GSEs are still in conservatorship. So yeah, I mean, to your point, should we be doing anything right now to increase demand, which has proven to be voracious? At the same time, FHA, I almost look at any government tax, or like anytime you can eliminate it, you can always raise it later, right? I mean, the reserve fund is at high levels, but it's not an easy decision, because we've already seen home prices appreciate almost 30% over the course of the last 2 years. Now you're talking about reducing the upfront commitment for people to buy homes with less than 5-10% down. So
David
tough
Stevens,
dilemma for the government.
he pleads a really strong case for MIP cut.
Who does?
David Stevens.
Oh yeah. Obviously very well-spoken, knowledgeable guy that's been there, done that, and got the Super Bowl rings to prove it. So we'll see. But announcement could be coming soon on that. A lot of smoke. Typically, where there's smoke, there's fire. And then what about the FHFA, the 50 basis point commingled security fee? That anything that you guys have been talking about or that's affecting you?
You know what? We price it all in. At the end of the day, we have to be sharp on the street. The argument here is that they're increasing it to offset counterparty risk. You know, and they're trying to justify if there's going to be an adverse impact to mortgage-backed securities and then the subset of the TBA market. But you know, I'd like to see the conservatorship end. You know, these GSEs are well capitalized, and it's kind of time to move on. You know, increasing fees again on the GSE side, does it make sense? I don't buy the counterparty risk side of it.
The whole, GSE public-private thing, it's nobody's really talking about it right now because they just know nothing's going to get done. But it's funny because like under Calabria and Trump, they were steamrolling towards getting the GSEs out of conservatorship. You change administrations, you change focus, more of a focus on using the GSEs to help bridge the homeownership gap and other goals of the administration. But I think what a lot of people don't realize is like, there's the government, they're backing the securities, right, which keeps rates low and keeps demand strong from bond buyers. So mortgage rates can stay competitive, but there's so much juice also in the government pricing, like that I don't think people realize. We've talked on this show before about like guarantee fees. It's embedded into lenders like Nation Lending, your cash pricing, but it's extra right now, an extra 40 basis points or so in price of just guarantee fee that the GSEs are collecting. We have the adverse market fee. We've got all the loan level price adjustments, and people arguing those are still too high. So there would be pros and cons of the government not being in charge of Fannie and Freddie. If it was a true private company, it'd be some things that would not be as good, but be some things that would be even better as well. So, Eric, affordability, such a big issue right now, just in our industry. And, one of the news stories that came across this last week was that made headlines was officials from the Bank of England overseas talking about 40 and 50-year mortgages to help combat affordability, help get people in loans, lower that monthly obligation. Also some talk about like assumable mortgage, like mom or dad would get a mortgage and it could be under certain conditions, assumed by an inhabitant child or something like that down the road. Got some people talking, are these solutions we may want in America? We've made a run at a 40-year fixed rate mortgage about a decade ago, didn't really get off the ground. Your thoughts on these alternative products, if they could be part of the picture?
I think they really could be options to kind of get more buyers out there qualified, more families and homes. The issue that you have is you've got to have the demand on the secondary market side, right, for those, right, for them really to take off. And then you still got to fix the supply issue, right? Until you get those, and you get buyers of some of these different mortgages and into securities, I don't see them going mainstream. But I would be a fan if we could help more families get in homes.
It's a great point. Like these mortgages that lenders like Nations and others originate, even banks and credit unions are putting a very, very tiny percentage of what they originate like on in their portfolios held for investment. Vast majority of all mortgages written in America need to be essentially bought in the secondary market by someone. And that fuels everything. It fuels why 30-year fixed rates are in the high fives right now, right? Because people that buy mortgage bonds, it's a fixed asset and they're terrified of inflation. People, we were to have a viable 40 or 50-year fixed rate mortgage in America, people would have to want to buy that in the secondary market. So to this point, been no evidence that that demand is there. Is some evidence though starting to pop up that there is demand for tiny homes. I caught my daughter like a couple of years ago watching one of these shows on, House Hunter, all those networks, specifically about tiny homes. It kind of caught me off guard a little bit. It's kind of becoming a thing. And then the Biden administration stoked that a little bit when it is part of their plan to help combat supply and the housing supply issue in America. They really spoke about ADUs, accessory dwelling units, small homes, garage apartments, homes that are built on the property of another single family residence. You don't have any ADUs on your Ohio property, do you, Eric?
We don't, but I do think these could go mainstream. When you think about that housing supply, this is a solution that could help a lot of people. You think about affordability, getting people over from renting to owning. They don't need a large footprint. I think this is an emerging segment.
The report that was put out by, I don't even remember who, but it basically predicted pretty massive growth to the tiny home market over the course of the next 3-4 years. And and the GSEs, potentially, they've talked about it, seems to make sense. Those being able to go on conforming mortgage products sold to the GSEs would only help stoke that market. So, and then what are you guys seeing? Second homes and cash outs. One of the other news headlines that came out over the course of the last week is just that the percentage of non-owner occupied products, no surprise, bought by the GSEs dropped pretty dramatically in the first quarter, year over year of this year. And again, that's not a surprise. Last year around this time, they hiked up all the fees on them. So it's partially a product of that, like Fannie and Freddie saying this is not our core business. But two, I think just that market slowed down a lot, right? I mean, just the general not institutional investor of non-owner occupied properties, it's just slowed down. We've seen all the signs of that these last several months here.
Yeah, so the GSEs, I think you mentioned it, really said that's not our mission, right? And primarily it's the primary residence homeowner, first-time home buyers. So as they started making those moves last summer, I think the slowdown is by design. We had to temper our business a little bit and make sure that we weren't overselling and over collateralizing some of that product. But it goes back to that secondary market demand, right? You've got to play within that box.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Nations Lending Corp. Executive Vice President and Chief Operating Officer, Eric Roman. And Eric, another report that came out this month, it came out this week on the past month, was from Black Knight, obviously their market monitor report. They're sitting on a massive amount of data, and rate locks down 11% in June from May. And it's been a weird, I cannot ever remember a year like this where we've seen like home sales in America go down small incrementally, but April to May, May to June, June to July. It's been a weird inverse year in a lot of respects.
Inverse is right. So, I mean, I think it's a direct correlation to the rising rates. You know, it's those rates were rising so rapidly. Rate locks fell across the board. Interestingly enough, we saw that drop from March to April at Nations, and May to June, we marginally increased in locks.
Nice.
And that's representative of our business, but you know, it's interesting to see that rates are rising so rapidly, and in general, IMBs and banks lock pipelines are down dramatically from this time last year going into a summer market.
Yeah, you rewind to a year ago. Last year, nobody expected it to be as busy as it ended up being. And I think it was at this time last year where lenders like yourself were like, man, this is going to be another good year. Like it is, rates are still low. We're still cranking out refi. A lot of demand to buy homes. Anything that's out there is getting gobbled up. And, and a year ago we were sitting in the twos or threes. And, but it's your point, the obvious impact of rates on this year, especially on refinance, but even on purchase, has helped, going back to what we were talking about earlier in the show, though, calm what was pretty out of control purchase market. It's some needed normalcy for the purchase market and housing in general.
Yeah, it's definitely cooling. Some of that appreciation that we're seeing, some of those record contracts, that wasn't sustainable. So I think we're seeing a little bit of the righting of the ship.
Absolutely. So some of the history of Nations too, you guys go way back. I'm Cleveland company, so I've been aware of you guys, and we're once a friendly competitor. And then one of our first members, thanks to you, when I made this move over here a little over 7 years ago. But you guys used to be a refi shop, like almost 100% refi. Like that was how I knew you as a competitor. In really bold and very well-timed, complete rebranding of the company about a decade ago. That's put you guys in the position you are now, where in a great spot and have really, really grown market share as we get into this year.
Appreciate the kind words there, Rich. Yeah, we grew up as a refi shop. We really understand lead acquisition, and we'll always do that business. It's always going to be there. I think you just kind of have to understand how to turn the knobs when the markets change and go after different segments and things like that. But the pivot to retail was intentional. Purchase business is a lot more fulfilling. It's who we want to be as a lender. I think back to almost a decade ago, we probably had a couple branches. Today, I think we're over 130 nationwide. Most of that business is traditional retail, referral purchase business, things like that, and that's what we're after, right?
Absolutely. So, got about 5 minutes left on the Last Week in Mortgage today with Eric Roman of Nations Lending Corp. You guys, like a lot of IMB, looking to grow, right? Talking to people, and definitely one of those companies that's looking to grow market share through a down market cycle, and been a lot of M&A this year, probably a lot more coming. Any changes in just that part of our business? I know it's been a very active recruiting year for the mortgage industry, to be sure. You guys have been right in the middle of that, trying to talk to people and let them know the great things you're doing over at NLC.
Yes, so last couple of years have been really active on the recruiting side, but we're in a contracting market right now, and I think that M&A activity is a lot hotter than I've seen it probably ever. There are a lot of opportunities where, if you don't take advantage of an opportunity when it's out there, you might not have a business in the long term. It's unfortunate. Some people will make it through this downturn, and some people won't. But I think it's an opportunity for some consolidation and some really good people to kind of merge and coexist in a new format.
Yeah, absolutely. It's like a reset of our industry in a lot of ways. There's been a lot of tech advances these last 5, 6, 7 years, but even that piece of it, I think continues to evolve and change. We've obviously gone from a refinance market to a purchase market, but even things like the pandemic has just changed a lot. I believe it's just increased the overall demand for housing in America. It's changed some of the dynamics just on the real estate side of our business and how people look at homes and, the realtor and referral part of our business. It's just been a dramatic amount of change for housing in general these last 2.5 years. Leaders like yourselves that are already tasked with constantly adjusting and adapting to change. The rate of that has been even more aggressive these last couple of years, and caused a lot of companies to figure out what we want your model to look like for the future of your company.
Yeah, we one thing I learned early in the industry was, change is constant. The industry's dynamic, our company's dynamic. And you kind of have to be able to manage through that. It's unfortunate that you see some companies. We kind of joked this week that the implodometer's coming back. That you're starting to see some big companies in the last several weeks, last month, go out of business, go through bankruptcy, get acquired, things like that.
Yeah, it's never a dull moment in the mortgage industry, and this year has been definitely no departure from that. So other things I'm just hearing, lenders looking to differentiate themselves. It's tough to differentiate right now, but I think that lenders are doing an increasingly good job at kind of seeking to do that, looking for product. You're in one of these markets right now where you got higher fixed rates and everybody's asking for every product, including the ones they'll never do, right?
I think that's just the nature of the business. You kind of have to have those tools in the toolbox, whether you're going to do them or not. At the end of the day, you got to have a good, strong, healthy business of just conventional government stuff, and you got to have some of the non-QM product that's out there. You got to have some of the bond and DPA type stuff. Some of that stuff's just always going to be that 1% of your business, the 2% of your business, but just got to have a good, strong, healthy core.
Absolutely.
The arms, right? The arms are coming back. Early on, when I originated loans, we sold our arms often, and I think rates have been historically unrealistically low. That our business wasn't a part of the equation, but I think you're going to see that continue to grow.
I remember being a young secondary guy selling pools of ARM loans, like lightly seasoned, for 3.5 point premium. And it's certainly a thing of the past, but ARMs, definitely more viable as a product right now. And you're starting to see that in the MBA app numbers and all the numbers that we see come out just on product. So Eric, anything else top of mind for you as we get into the second half of what has been an odd year for the mortgage industry?
Yeah, I think it's we're in a period where everyone just kind of needs to keep their head down, stay focused on their business, stay focused on their people, and we'll all weather the storm, and most of us will come out of it stronger than going in.
I know you guys will. It's been fun to watch your growth, not only in my years here at TMC, but preceding that, and just appreciate greatly all that Nations Lending does, and you specifically, Eric, somebody we constantly call on to be a thought leader for our network. All you do for our network as well. It is greatly appreciated.
Always a pleasure, my friend.
And I can get my Cleveland sports fix in talk with you as well, which is always a good thing for me. So
next up, let's see the Browns come out and figure this out. See where we go.
Everybody just waiting on like who's going to be our quarterback, and and how long is he going to be suspended, and so we can just kind of like move forward and start over rationally getting excited for the season, the expectations for the season. Excellent. And to our attendees, thanks as always for taking 30 minutes of your week out with us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. You can also find us on YouTube after the fact on video, and where most of you listen on podcast, Apple, Spotify, all the different platforms. Just search TMC Connect, subscribe to our feed, and you can consume the program that way as well. So Eric, always appreciate the conversation on the industry and you taking the time out.
You got it. Thanks, Rich. Appreciate you.
Have a good one, bud. Take care, everyone. Have a great rest of the week.